Hello, welcome to the August market update. Tony Marlette Jr. at Brookside Tax and Financial Group. Let's take a look first at what markets did in July. Stocks were up, S&P 500 and the Dow Jones. The Nasdaq was down a little bit. That was a little bit of a change of pace, on 1.5%. And the Russell small caps were up over 10% for the month. That's right, 10% for the month. We'll look at why that is. And then bonds crossed into positive territory year to date, finishing July up a little over 2.25%. So the small cap index was up such a large amount in July. Not hard to see why when you think about some of the economic indicators that we saw. The expectation of lower rates, interest rate cuts that the Fed has been talking about for a while now, pretty much largely believe that this is going to happen in September. And that really benefits small cap companies because they're smaller companies and they tend to borrow more. So their borrowing costs are going to go down. And they're also mainly a lot of the ones that are in the ETFs and the different mutual funds, US focused. Some other economic indicators that we're looking at here: unemployment up to 4.3%. And then also spending and earning are down as well. Remember, the Fed has the dual mandate: maximum employment and stable prices. So these reasons, not necessarily alone, but these reasons are what we believe led to the uptick in small cap stocks. It is important not to chase excessive risk. And we talk about that all the time. So it's important not to jump on the bandwagon now. It's also important to not eliminate small cap exposure as well. You want to have the right amount of exposure for the right amount of risk. And what about bonds? So when interest rates go down, bond prices tend to go up. We've talked about this coming now for a few months, where we could see bonds getting back to acting more like traditional bonds in the sense that they provide some stability to a portfolio. However, when prices go up, yields or income goes down. And if you think about it, it makes sense because bond prices go up, that drives the percentage down, and the percentage is based on the income in relation to the bond price. So prices go up, yields go down. We saw the 10-year treasury dip down to 4.09% in July, and it was up at 4.7% April, which was the high point of the year. We mentioned earlier, bonds finally crossed into positive territory year to date. We're going to be having some turbulence for the rest of the year potentially. And as we sit here in August, beginning of August, it's certainly shaped up that way. By the year end, we're expecting at least one rate cut. I think the possibility exists of as many as three rate cuts before the end of this year. We do have an expensive market, an overvalued market, as we've talked about before, and then a presidential election on top of that. So it's never been more imperative to maintain a balance of safety and growth within your portfolio. If you'd like to review that with us, feel free to do so. You can look at us on YouTube, our Facebook page, and our website as well. From all of us at Brookside, we thank you for working with us, and we continue to look forward to working with you.